Good morning, everyone. Welcome back to Morning Markets on Monday, the 1st of June, as we kick off a new month. Just looking back over the previous month of May, what did we really see there in asset markets? Well, a continuation of the trend that we've been discussing over the past number of months, that ongoing improvement from the lows that we hit at the end of March. So we continue to see higher risk asset classes such as equities, high yield debt, emerging market debt perform well over the course of the month. We saw a bit of a change as well within equity markets, with both Europe and Japan performing well, and a bit of a broadening out from the US-centric leadership that we've talked about. I think the other thing that was observable within those markets and why they have potentially performed a little bit better is just that we saw some of the cyclical areas of the market start to perform well, and that plays into Europe, given the exposure to financials. I think the other thing that's helped Europe over the course of the month clearly has been what's been happening in bond markets. So we have seen European spreads in particular relative to Germany, come in quite a bit for the likes of Italy and Spain. Why is that? It's to do with the package that was announced last month. So that was a real positive for Europe during the course of the month, and indeed it was also a positive for the euro. Just looking at other sovereign bond markets over the course of the month, probably little change really when we look at 10-year yields, particularly for the US and UK. So nothing exciting there, if you will, to discuss. Turning to currency markets, what did we see? We saw, as I alluded to there, just a bit of a better performance from the euro over the course of the month, and some US dollar weakness, just given that slightly shift in rotation that's been going on. So those are some of the trends that we saw last month. What does the new month herald for us? Probably some continuation of the same. I think the other factor that we touched on towards the end of last month that was coming back to the fore was some of the political risk element as it related to both US and China, but also Brexit and the discussions that are ongoing between the UK and the Eurozone. Turning then to the markets on Friday, I think the one thing that we discussed that we'd be looking out for was what President Trump would say about the US relationship with China. When it came down to it, the discussion was really lacking of any great detail. There's probably a lot of noise, but not any significant change, and that's borne out when we look at the performance of Asia today, and in particular Hong Kong, where we've seen that market increase 3 to 4%. So just a little bit of relief that there was no additional measures from the US against China in that discussion. The other thing that we saw from China over the weekend was the purchasing managers indexes, both looking at manufacturing and services. Looking at the manufacturing one first, you'll remember that we've seen an improvement in this month-on-month for the past couple of months. Surprisingly, I suppose this month, what did we see? We saw a very slight deterioration in the reading. So the reading came in at 50.6 versus 50.8 last month. So not really a significant change, but disappointing, I suppose, that we're not continuing to build on that trend of improvement. And it just highlights the challenge, I suppose, that manufacturing does face, given it is linked to the recovery in international economies and the reopening of international economies. On the services side, services has continued to improve to 53.6 from 53.2 last month. In both of those, the outlook component, however, is meaningfully stronger. So that does give us some conviction around how the recovery in China continues to evolve in coming months. The Casson survey, which is a private survey, was done and focused on the small and medium-sized manufacturing companies within China, moved above 50. A reading above 50 is an expansion, and that was the first time that we've seen that since the impact of COVID-19 on the Chinese economy. So again, all of the indicators pointing in that positive direction of improvement, albeit possibly not at the speed that had been expected. Then turning to the week ahead, we've got quite a lot of purchasing managers indices for Europe, UK and the US to come this week. Again, it's the forward-looking element of those that we find interesting, and it's worth noting and looking at how that's improving. We'll also have the ECB meeting this week. I think this is an important meeting for the ECB, just given what's been happening in terms of European asset markets, but also the expectation of change around their stimulus or support program that they have, so the expectation being that will be meaningfully increased. So we'll look out for that. And then towards the end of the week, we have the US unemployment report, which will be the one which will really capture all of the jobs that have been lost so far as a result of COVID-19, and the expectation that the unemployment rate in the US could be anything between 18 and 20% when we get that figure. We won't hear from any of the Federal Reserve Board members this week, given that they're in sort of a blackout phase ahead of their meeting next week. Please join me again tomorrow when we'll look at more morning markets, and then look out for the chart of the week from my colleague Chris Leyland, which will come out later today. Many thanks.